The triangle price pattern is a type of continuation price pattern where prices get compressed and converge over time until price breaks out in either direction. There are three types of triangle pattern: the symmetrical triangle, the ascending triangle, and the descending triangle, each with different trading strategies. Hi, this is Spencer, founder of Synapse Trading, and I've been trading and traveling across the world to teach and inspire others how to do the same. In this video, I'm going to talk about how to take advantage of the triangle pattern to trade breakouts, how to avoid false breakouts, and the best trading strategies for this price pattern. First up, what are triangle patterns? A triangle pattern, as its name suggests, is a triangular consolidation range in which prices move about. The triangle pattern generally represents a medium-term consolidation of prices and is usually found in the mid to late stages of a trend. Since it is a medium-term pattern, the triangle pattern usually consists of 50 to 100 bars and most of the time results in prices breaking out in either direction as prices get compressed. As prices get squeezed towards the tip of the triangle, prices will be forced to break out of the pattern, and the direction it takes will depend on the type of triangle. As I mentioned before, there are three main varieties of triangles, namely the ascending triangle, the descending triangle, and the symmetrical triangle, and we will be going through each one in more detail later on. So what is the psychology of a triangle pattern? In a triangle pattern, bulls, which are the buyers, and bears, which are the sellers, are fighting, and both sides are trying to gain control. Bulls want higher highs and higher lows, while bears want lower highs and lower lows. As the fight intensifies, uncertainty increases and volume decreases as the range of prices start narrowing, so both bulls and bears choose to wait on the sidelines until the direction becomes clear before jumping in again. That is why once a breakout occurs, price and volume tend to spike as all the buyers and sellers waiting on the sidelines start making their move. So how do we tackle each type of triangle pattern? As we have seen, all triangles consist of two sloping lines which converge, but the main difference lies in the gradient for each pair of lines. For the symmetrical triangle, both lines are sloping inwards. The top line slopes down and the bottom line slopes up, whereas in the ascending triangle, the top line is flat while the bottom line slopes up, and for the descending triangle, the bottom line is flat while the top line slopes down. The slope of these lines have a great significance, which I'll be covering in greater detail by going through each triangle pattern. The symmetrical triangle with its converging lines shows that both sides, the buyers and the sellers, are equally matched, which makes it hard to predict which side the breakout is going to happen. Since it is a continuation pattern, the odds will tend to favor the direction of the existing trend, but it is still much harder to trade compared to the next two triangle patterns. The ascending triangle with its bottom line sloping up shows a bullish bias, as this indicates a series of higher lows. If you recap, a series of higher lows and higher highs is an uptrend. The flat line on top, which now serves as resistance, becomes a clear level for price to attack and break, and if it succeeds, will lead to higher highs. Hence, there is a higher probability of an upside breakout for the ascending triangle, especially if it forms in the middle of an existing long-term uptrend. The descending triangle with its top line sloping down shows a bearish bias, as this indicates a series of lower lows. Now if you recap, a series of lower highs and lower lows is a downtrend. The flat line at the bottom, which now serves as support, becomes a clear level for price to attack and break, and if it succeeds, will lead to lower lows. Hence, there is a higher probability of a downside breakout for the descending triangle, especially if it forms in the middle of an existing long-term downtrend. Now, let's talk about triangle pattern trading strategies. There are two main strategies which focus on the directional triangles, mainly the ascending triangle and the descending triangle, and the difference lies in how early to enter the breakout when it happens. In the breakout entry, we enter immediately, whereas for the pullback entry, we wait for a pullback after the breakout. Something to take note of, breakouts usually occur when prices are around 2/3 to 3/4 of the pattern length, And if prices go past the 3/4 mark, there is a possibility that prices may just continue to meander sideways without breaking out. This would mean a failed pattern. Now let's go through each strategy in greater detail. Our first strategy for the triangle pattern is to enter on the breakout of an ascending triangle or descending triangle pattern. As mentioned previously, a triangle is a compression of prices while buyers and sellers wait on the sidelines for a breakout. For this setup, we'll be looking to enter just as the breakout happens. In the example above, we see a prior uptrend, so we know the odds for an upside breakout are higher. As the ascending triangle forms, we see a series of higher lows and similar highs forming while showing a gradual build-up of bullish pressure. We also see prices pushing against the resistance level formed by the similar highs. Finally, the resistance gives way and prices break through. For trading, we will look to enter near the point of breakout, keeping an eye for strong price action and volume to support the breakout. We can also use the breakout bars to place a stop loss. Note that this strategy works just as well with a descending triangle. You just have to flip the pattern around for a downside breakout. This strategy works best if the prior trend, which is the one before forming the triangle pattern, is strong and has a higher chance of success if the triangle is smaller in terms of height and duration. Our next strategy for the triangle price pattern is to enter on a pullback after the initial breakout. As covered in the previous setup, one of the ways to trade an ascending triangle or descending triangle is to enter the moment price breaks out of the pattern. However, sometimes the odds of a successful breakout might be lower. For example, if the triangle pattern is large, which means that there's more uncertainty, or the pattern goes against the prior trend. For example, a bullish ascending triangle in a downtrend or a bearish descending triangle in an uptrend. In the example above, we see a prior uptrend followed by a bearish descending triangle. This sets up a little contradiction which suggests that the breakout might not be as strong or as clear-cut. Therefore, when the breakout happens, instead of entering this trade immediately, we wait to see if there's a pullback to test the support turn resistance level, which was the flat line of the descending triangle. For trading, we will look to enter once the pullback is completed and prices start to head back down. The end of the pullback would also be a good place to place your stop loss. Note that this strategy works just as well with an ascending triangle. You just have to flip the pattern around for an upside breakout. You might have noticed that I left out the symmetrical triangle in both the strategies mentioned earlier. The reason is that I find the symmetrical triangle the least reliable pattern of the three triangle patterns. This is because it is hard to confirm a successful breakout of this pattern and even harder to determine a good entry point. In the example above, prices have broken up to the upside of the symmetrical triangle pattern. However, because of the nature of the pattern, there will still be another high or low if it broke to the downside, which prices have to surpass, and it becomes a resistance level. As a result, even after the breakout, we are not sure if prices have started trending or whether prices are still trading within a wider range. We can only be sure after prices have broken the new resistance level and continues climbing, in which case the original symmetrical triangle breakout did not really have much significance or trading opportunity. Hence, I will prefer to focus on those patterns which have a more predictable outcome. Next, how can we get a price projection for the triangle pattern? Once a triangle pattern is completed, one of the most useful things about it is its ability to provide a price projection, which can be used to estimate a minimum profit target for your trade. This can be done by taking the maximum height of the triangle and projecting that distance from the breakout point. In the chart above, the maximum height of the triangle is indicated by the blue rectangular box, which is then used as a price projection at the breakout point. The black horizontal arrow indicates the price level which serves as the minimum profit target for the triangle pattern breakout. This price projection technique can be used in conjunction with other methods such as support and resistance levels, and if there's any confluence, like with moving averages or price pattern, it gives an added layer of confirmation. Before we conclude, here are some practical trading tips from the trading desk. Number 1. trade with the larger trend as breakouts are more likely to happen in the same direction as the prior trend. Number 2, watch out for triangles that are themselves a part of a larger price pattern. And number 3, look out for major support and resistance levels. As you can see from this chart, this is an example of trend trading using the triangle pattern, because the triangle formed is actually a consolidation pattern within the major trend. So this whole triangle is actually a pullback opportunity to enter the underlying trend. Although we generally do not like trading symmetrical triangles, the odds in this case are better than 50-50 because there is a higher chance of an upside breakout due to the context, which is a triangle pattern pullback in a major uptrend. Besides strong trends, triangle patterns can also form near the edges of support or resistance levels when prices are trying to push through that price level, so you might see them near the necklines of other patterns such as the double top, double bottom or the head and shoulders pattern. In a sense, the triangle pattern becomes part of these larger patterns depending on the context. Now that I've shared all about the triangle price pattern, what is your favorite triangle pattern trading strategy? Let me know in the comments below. And if you have enjoyed this video, do remember to like and subscribe and hit the bell notification icon to receive the latest updates. That's it for this video, and I'll see you in the next one.